A brand new crypto token just pulled in over $111 million in trading volume on its very first day. This chart shows that day one volume surging to $111 million without a traditional hype cycle or months of community buildup. Landing a simultaneous listing on Coinbase, Binance, and Kraken on launch day is incredibly rare. It signals serious institutional weight behind the scenes, yet retail investors had almost no warning. The token, called NEX, hit the market with zero fanfare, leaving most people completely unaware of what it actually does. This exact setup creates a dangerous trap. When retail buyers see Tier 1 exchange logos, they often skip their due diligence and buy in out of a fear of missing out. To figure out if NEX is actually worth that blind trust, we have to look at the infrastructure. Nexus is its own Layer 1 blockchain. It wasn't built on top of Ethereum, and it isn't running on Solana. Nexus Labs built this network entirely from scratch. It is designed specifically as financial infrastructure for autonomous AI agents to execute high-speed transactions, rather than human users. To make these machine-to-machine transactions secure, Nexus relies on zero-knowledge proofs. This is a mathematical system that verifies a transaction is completely accurate without ever exposing the underlying data to the network. Because the network doesn't have to process the raw data, these AI transactions settle incredibly fast, stay entirely private, and require zero trust between parties. The technology is highly capable on paper, but the trade-off is steep. Adopting it requires users and developers to migrate away from established chains to an unproven ecosystem. Evaluating the technology is only half the equation. The financial structure of Next presents a much harsher reality. Looking at this visual supply model, when Next launched in May 2026, it hit the market with a circulating supply of 60 trillion tokens. Right now, there is zero confirmed burn mechanism in place to reduce that number. The supply can inflate indefinitely. To make matters worse, the development team is actively hiding the full tokenomics and the internal vesting schedules from the public. Operationally, this means early investors are flying completely blind. There is no way to know when founders or private backers will unlock their shares and flood the market. This lack of transparency is highly alarming, especially when paired with the heavy institutional backing we saw on day one. Without knowing the schedule for future supply dilution, calculating an accurate long-term valuation for Nex is mathematically impossible right now. That combination of launch day hype and completely hidden tokenomics had an immediate, aggressive impact on the price action. This chart tracks the initial launch spike, pushing the token to an all-time high of 0.000000697 and a $314 million market cap. But shortly after, the price plummeted, suffering a brutal 52% pullback down to the 0.0000033 level. This is a textbook post-launch dump. Early insiders extract their liquidity by selling into the retail demand generated by those Tier 1 exchange listings. Given the severity of that drop, current market sentiment is highly cautious. To confirm any real bullish recovery, the price needs to break through that critical resistance zone near the original all-time high of 0.000007. Buying the dip right now offers a 50% discount from the peak, but it exposes your capital to heavy sell pressure if those undisclosed tokens unlock in the near term. So you have a direct conflict: elite institutional listings on one side and highly restrictive hidden supply data on the other. Nex is a deeply polarizing asset. You cannot evaluate it with a simple good or bad label. If you are a momentum trader, you operate with a high risk tolerance and trade entirely on narrative energy. From that perspective, a 52% jip on a token with Coinbase and Binance listings, plus the popular AI and ZK narratives, looks like a prime entry opportunity. On the other hand, if you are a fundamental investor, your priority is risk mitigation and transparent, sustainable growth. For you, the lack of a burn mechanism and those completely hidden tokenomics turn this project into a structural trap. Taking a position on Next requires you to honestly self-identify your specific trading strategy before putting any capital at risk. Here is the operational breakdown for both approaches. On this decision map, speculative momentum traders should keep Next strictly on a watch list, focusing entirely on a volume break at that 0.000007 recovery zone. Fundamental investors should completely avoid the asset until the development team officially releases the full supply investing schedules. Ultimately, the hidden tokenomics make Next too dangerous for a blind buy. But its day one institutional footprint makes it too massive to ignore. Are you trading the momentum or staying away? Let me know in the comments. Drop a like, subscribe, and hit the bell for more crypto breakdowns every week.